Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
So, Charles, what I was looking at today, it's been kind of amazing, the news cycle here on retail investors. There's companies like this Chinese company, Fanged, F-A-N-G-D-D, that was up like almost 400% overnight one night. And there's other stories like that. Have you been seeing that and seeing, this spike in retail trading? Have you been noticing that?
Yeah, I have. I mean, Hertz surprised me. I knew they filed for bankruptcy, and then all of a sudden their stock jumped huge. Even on one of our model portfolios, I had looked at adding Michael's, the big arts and crafts store, and I ended up passing on it. But Monday, I think it jumped up by about 40% on Monday. This Fang thing, I didn't know about it till today, and it's somewhat of a shocker, although we saw it. There's Zoom Communications, and there's another company, I think with a ticker Zoom, or a similar name, that had a big run up because people thought it was a video company.
Yeah, it seems like anything that has some kind of tech associated with it is getting a bid and getting a lot of trading activity.
I'll say it kind of reminds me of the dot-com bubble, where if you said, change your name to .com, you'd see your share price jump.
Yeah, so speaking of which, where were you during the dot-com bubble?
I was working in finance then. I actually was working for an old company called Telescan that used to... Now they've been absorbed by TD Ameritrade, but we were right in the middle of it. And I remember crazy things. I still recall buying CNET and selling it for about a week later at an 80 or 90% gain. It seemed as if these .com stocks, you could put on a blindfold, throw a dart, and pretty much make money quickly. And we've seen this play out. We saw with housing, saw with gold a little bit, and now we're obviously seeing it now with sports betting being shut down. A lot of people are piling in, and certainly the no commission trading. It seems a lot of people don't sit back to read market history and ask, has this happened before? And if it has, were the outcomes positive? Because it seems every so often this behavior just resurfaces.
So I'm here speaking with Charles Rotblut of the American Association for Individual Investors. Charles is vice president and editor of the AAII Journal. Charles, again, thanks for joining us today.
Thank you.
And I'd like to continue the discussion about individual investors today. We've been talking about how they've had such an impact. It's amazing what kind of impact they can have when they all come to the table on the market today, and seeing some of these small stocks get pushed around.
Yeah, and it's hard to say exactly what's driving it particularly. I mean, obviously there's a gambling, a speculative type instinct, but we've also seen reports of some of the guys that are really big into fantasy sports move over into investing simply, I guess, because they have nothing to do right now. But there's this old problem that with investing, a good analogy is poker, and obviously poker is gambling, but with poker, if you have a few $100, you can show up at a casino and start playing. And it doesn't take a huge amount of wealth to show up at the World Series of Poker or another big event like that, sit down. And the problem is when you sit at the table, you really don't know who the sharks are. And chances are there's people there that really know what they're doing. Obviously, in the case of poker, better skills, better knowledge than you do. In the case of investing, just better research and better equipment. Last year, there was a discussion about data coming from the New York Stock Exchange when NYSE wanted to actually broadcast data directly. And a lot of data firms that were across the river were getting angry because even though it wasn't a big distance, that small difference made a change in how quickly information got spread out and how quickly people reacted to it. So when you have professionals literally worrying about milliseconds, to think you're going to jump on your Robinhood app or log into the Fidelity website and think you're going to be able to trade faster than these professionals is just a fallacy. Could you get lucky? Could you make money? Absolutely. But there's a big difference between being lucky and being skilled. And in a lot of situations, people too often confuse luck for skill. And ultimately in investing, it's a matter of patience and skill that's going to win out over the long term.
Yeah. It almost seems like people are doing this as kind of a pastime, kind of like you said, without sports and, to bet on, something to kind of pass the time a little bit in the stock market.
Yeah, and I think even with fantasy sports, that's become really huge. But even then, I don't think people necessarily understand the odds. People might have played a lot of fantasy football or baseball with their friends, and maybe they've done well in the leagues they play in. But when you start getting to these higher levels, where there's a lot of money on the line, you start hearing reports about these guys that spend most of their week analyzing things. And the person that might be playing a casual fantasy football league really doesn't have much of a chance against the guy that can pull out a spreadsheet and say, well, this running back does really well on AstroTurf when it's wet. And this guy does really good when the wind's gusting at 30 miles an hour. And the same thing when you look at investing over a short time period, you're dealing with a lot of high frequency traders, a lot of trading firms, a lot of hedge funds, and you're trying to play often in the same sandbox as them instead of taking a look at the broader universe. And there's about 5,000 exchange listed stocks, and look at that broader universe and saying to yourself, well, what stocks are looked at less often? Or if I'm going to go after a better known stock, what are my specific criteria I'm going to look at that's going to give me an ability to actually hold the stock for a while versus thinking, say, I'm going to buy Apple today and I'll sell it in an hour. That's just not a way of succeeding as an individual investor.
Yeah, yeah. Again, I hope it's just more pastime for them than like putting serious money into the market. There's been another news angle on this too, where the individual investor has kind of beat institutions, at least in the short-term performance angle. I mean, that's kind of one of the angles that AAII kind of talks about too, don't they? In terms of like, is there an advantage that small investors have over institutions, maybe when it comes to say small stocks? And maybe this is a different angle too. I mean, obviously, I think day trading is a different animal, but
Yeah, there's actually two big advantages. And one of the things I always try to remind people, your biggest advantage of being an individual investor is just never having to report your performance. A lot of these institutional fund managers are being measured on 3-year periods. And if they don't beat their benchmarks or beat their peers over a 3-year period, they stand to be fired. And some people might say, well, that's just kind of rumors. That doesn't really happen. But I've sat in investment conferences where I've seen people say to a speaker, I understand your strategy works really well over the long term and it can make me a lot of money, but my clients don't have the patience to wait it out. So that's one big advantage. But the other thing is we do actually operate at AI our model shadow stock portfolio, and it looks at the smallest stocks, market caps between 30 and $300 million. And we're also looking at the cheapest decile, cheapest 10% of stocks. And it's really based on the old research by Eugene Fama and Kenneth French about that if you go very small and you go very cheap, that's where your long-term performance is going to come from. Now, it does require patience because it's a very specialized strategy. It's going to have years where it does really well. It's actually going to have streaks of years where it does really well, and streaks of years where you're going to pull your hair out. But when you look at the long-term performance, it's far above the S&P 500, and it really comes to being an individual and realizing I don't have to worry about my quarterly or my annual performance. I just have to worry about my goals. If my goals are long-term, then I should be willing to withstand short-term volatility because it will pay off over the long term.
let's talk a little bit about risk tolerance, perhaps, and perhaps the effect of the coronavirus, and also just kind of against the backdrop of this news cycle we talked about with the high frequency or day trading. I guess I would have expected such a deep drop in the market because of the coronavirus to have a negative impact on investors' risk tolerance. Have you seen that, or have you seen something different?
We've seen something different, but it's an interesting question because we surveyed our members, and our members, by and large, tend to be long-term investors. But what typically happens when you have bear markets, you have the people that stay engaged and are willing to talk, and then you have another group, and they're not really measurable because they really panic and they slink away, and so it's really hard to measure what that group is. But that's often the group that does themselves the most harm. Our members, they actually stayed pretty disciplined throughout the coronavirus. About 44% said they were buying. One member wrote to me and said, to a survey we did, I've been waiting 2 years for an opportunity like this to surface so I could buy. Another 35% or so of our members said they just stayed the course. They're long-term investors. And there have been some studies to show that with individual investors, as they experience more and more volatility, they tend to get more used to it, and they do tend to react less to it. You still do see some reactions in one study showing that people don't fully learn not to keep reacting to things, but we do see over time individual investors gain more discipline. But you do have this group of new investors that haven't been invested in the markets long. And particularly if you look at somebody who got into the market, say 2000, 2001, they had a dot-com bust, they had the financial crisis. And just now they're feeling like I got back on safer ground. You had the coronavirus occur. And we kept talking in between Greek financial crisis, the flash crash. And for some people, it can be very unnerving. Uh, but we do see by and large, our members, and thank goodness they're listening to us, are taking a longer term view, viewing volatility as an opportunity to actually buy stocks, because really volatility is just the price you have to pay to get higher returns. If you want higher returns, you have to withstand some roller coaster rides. Maybe grab, your Tums or your Rolaids or whatever your stomach medicine of choice is. But you do get compensated for it. If you don't want risk, CDs will give you no risk, but you'll lose out to inflation. So fortunately, our members have been listening to our words and taking our guidance as far as just stay the course and focus on your long-term goals, not what Mr. Market does on a day-to-day basis.
Individual investors also have, well, as we've seen, they've had an impact in the market recently. You guys also produce something called the sentiment survey. Can you talk about that and what that measures and what that shows?
Yeah, absolutely. That's a survey we've run continuously since 1987. And the entire time, the questions has never changed. It simply asks members, I feel the direction of the market over the next 6 months will be up, which is bullish, unchanged, which is neutral, or down, which is bearish. And the only thing that's really changed with the survey is sometime in the mid-90s, we went from mailing out actual physical postcards to doing it online. And what we found over time is there is a link between optimism and the returns of the market. And there's that old adage that you should buy when there's blood on the streets. We've actually found it's really you want to buy when everyone else is afraid to buy. When we look at it's really the optimism that has a strong link. And when we look at optimism, unusually low levels of optimism, meaning that if we take the standard deviation, so we have the average of optimism, and then which is 38.5%, and then we can draw a band, and it's about 10 percentage points in each direction. If it's outside that 10 percentage point band in either direction, there tends to be a link between those readings and the performance of the markets. So what we found when optimism gets too low, say below about 28%, the market tends to outperform over the next 6 and 12 months versus the historical average. When optimism is unusually high, we tend to see underperformance. Now, keep in mind, we tend to still see gains, but those gains tend to be smaller than they are on average over every week when optimism is too high. Now, there is some link between pessimism as well, but it's not nearly as strong, and we don't really see the same difference in returns. And it actually makes sense because when you look at bear markets, usually what happens with the selling is that people see other people selling, they get nervous, and everyone's afraid to buy because nobody wants to buy a stock and see it fall the next day. That's happened to everybody. It's never a pleasant feeling. And so people are afraid to buy because they don't want to lose money. And certainly we humans are loss averse. And so we want to avoid those situations.
So we're in early June 2020 right now. What is the current situation of optimism versus pessimism right now?
So right now it's in about the mid 30s. So it's staying below its historical average. And we've seen it stay below its average of about 38% throughout the full year of this year. And really over the past couple of years, we have not seen optimism being above average on the majority of weeks. Most weeks it's actually been below average. So we've had this run of really people not being overly optimistic about the markets. And prior it was about valuations, some concerns about the economy, certainly some concerns about politics as well, given the partisan environment we continue to be in. But more recently, we're really seeing the coronavirus play a role. And it's really the uncertainty about the virus. And I think on a coronavirus standpoint, really, if there's a vaccine, I think that would give people a lot of confidence. And we've certainly seen the market move on even the mere mention that a vaccine could potentially come out this year, or maybe Fauci says a vaccine early next year's within the realm of possibilities. Not saying a vaccine's actually there or it's going to be a reality, but even just the thought that it could be a reality, we're seeing movement in the markets because of it.
So what are the questions? Or is it as simple as, do you think the market's going to be up or down over the next 6 months? Or what are the questions that go in the survey?
It's simply that we ask them, do you think the market's going to be up, flat, or down? And then we always tend to ask them a special question afterwards, week after week, just trying to get a little bit of color in what they're thinking, what they're noticing. And that question changes, and sometimes it'll be about something recently occurring in the markets. Thanksgiving, we might make it a little bit creative and start asking them, what's your favorite Thanksgiving dish? And sometimes we get some pretty funny answers to that. But we tend to try to ask them color. How do you feel about valuations? What's influencing your sentiment right now? What do you think about the housing market? So we do get a little bit of color in that standpoint, but what we're really measuring is that one single question. And like I said, we've been tracking it since 1987. So we have a long record of how people are responding, what's typical and what's unusual.
Yeah, and you provide the scores on the website, like for subscribers to be able to download the historical scores and just kind of track that.
Exactly. So yeah, our members can actually download a spreadsheet with all the data. It's actually the data itself. Anybody can actually view it. AAII.com/sentiment. You don't have to be a member. It's actually on our website. It gets updated at 12:01 Central Time AM every Thursday morning. Our database just cranks out the numbers, so it's open for anybody who wants to look at it.
So I'm curious also, there's a couple of proposals out there that I think would impact individual investors today. One is the SEC's proposal to amend the accredited investor rules. I don't know if you've come across that or had a chance to look at that and perhaps have an opinion in terms of what that could mean for individual investors.
Yeah, I do. And we actually had a webinar with SEC Chairman Jay Clayton about 2 months ago, and that question did come up from some of our members. There's certainly interest in it. Right now, for those not familiar with the rule, it's really based on income and wealth. And the SEC wants to modify it to actually consider knowledge and experience. And I think it's a positive thing to do. And I do think knowledge and experience should be part of it, because you could have been very successful in a different field. Maybe it's engineering, maybe it's medicine, maybe it's technology, but your expertise and your skill in that one field doesn't apply to other fields. Now, if you're a smart person, you certainly can pick up investing, you certainly can learn about it. But I've always thought there should be a knowledge component, because you really want to know what you're doing before you're getting into these investments. The other thing is, and I know a lot of advisors are trying to do more private placement, private investments. Vanguard's certainly getting into it. And I think the other thing is that people need to tread carefully. I happen to start my career valuing privately held businesses. And it's really a different ballgame, because if I buy Nike, if I buy shares of Merck, I know exactly what the price is any moment the market's open. And any minute the market's open, I can sell it close to or at the listed price. But if I'm buying a company that's not publicly traded, I don't know for sure what that valuation is. And I don't have the ability to quickly sell my shares either, particularly at a favorable price. And so when you start getting to more privately held businesses, the valuations do become a little bit more of a guessing game. There are metrics they can use to say this should be worth this or that should be worth that, but the comps are a little different. You do not have this market that's constantly repricing assets saying this is what the current price is. And a good analogy is, if you're buying a house and you go to sell it, anyone who's trying to sell the house knows you don't know exactly what price you're going to get till the offers come in. It is a different ballgame, and I encourage people who are thinking about to really make sure they understand what's going on and make sure they know how to read a prospectus and make sure they know how to actually analyze the business operations, because it is a different ballgame.
So the other proposal that's out there comes from some of the top names in the ETF space, and it's a way of simplifying the ETF labeling, ETF naming. They propose an ETF classification scheme. If you've had a chance to look at that or had a chance to ponder that, I'm curious about your thoughts if that goes far enough to help simplify and make things more understandable to investors.
Yeah, I understand the logic. My concern is it's going to create an alphabet soup. Right now, I don't know how many people really understand the difference between an exchange traded fund and exchange traded note. Certainly, a lot of people watching this might very well know the difference, but to the average person on the street, they may just assume an ETM is the same as an ETF. Even though, as we record this, about a week ago, the Wall Street Journal did an article about somebody who had invested in ETNs thinking they were safe and ended up losing most of his wealth because it was actually a debt instrument that ended up defaulting, essentially. Now we're talking about adding on more letters. I've heard the term ETI and some other things. And my concern is it's going to add more confusion, or instead, perhaps just some labeling saying this could actually result in a high level of risk, or better yet, trying to actually encourage people to read the prospectus. And obviously, that's hard to do, but it's really important not to judge a fund by its names and get people to really understand that you have to look at what you're investing in. You could take a fund that has S&P 500 in its name and assume that you're buying the S&P 500, but in reality is you might be buying some subset of it. Perhaps you're only buying the value stocks in S&P 500. Perhaps you're only buying the growth stocks. Or if you're looking at ETFs and you want to invest in Africa, you should automatically assume every Africa ETF is the same. You want to look at it. And one of the things I always tell investors to do is if you're looking at ETF, look at what index it's actually based on, and then Google the index. And so very often you can actually find a methodology behind the index by just doing a Google search and try to get a sense of what the index is designed to do. Take a look at the companies and see how they compare or differ, because two similar sounding ETFs can be very different. And certainly anytime you see 2 times or 3 times attached to the name, that should be a sign right off the bat that this thing's going to be riskier, because while you can make double, triple the money, you could also lose double or triple the money very rapidly.
Indeed, yeah, those are good rules of thumb. And yeah, I don't know if the alphabet soup, as you put it, would be the appropriate thing in terms of making things simple. I mean, I have friends that I talk to that are not in the industry. I try to tell them I work in ETFs, and they have no clue what I'm talking about. I can't imagine trying to go buy an ETF versus an ETI or an ETC or whatever. I mean, I wonder how. Yeah, to your point of looking at the prospectus, maybe we just need a better one-page summary, followed by all the detail, but kind of summary. This is the risk that you face. Here's the tax applications or the tax implications, and this is what it invests in. Just brief summary that you don't have to dig in too deep, but at least you might understand kind of right off the bat that it's a little different than other things.
Yeah, I agree. Even a simple, paragraph, this is what the fund does, written in layman's terms, not, I've been in conversations, I'm sure you have too, with industry professionals, and you understand what you're saying. And I've certainly been at conferences where I want to look at them and say, I know what you're saying, but let's just use plain English.
Yeah.
And I think sometimes you look at these ETF fact sheets and they're clearly written for professionals, which is fine. But I think having a version of that for the individual investor, or even for the institutional investor who's maybe working on a pension fund, just so they can look and say, okay, I understand what this fund's trying to do and how it might differ than something else that might have a similar name to it.
Do you think broker dealers should have gates, kind of like they do for options trading or futures trading, where somebody needs to qualify or attest that they are sophisticated enough before they buy, say, a 2 times product or something that has commodity futures in it?
Yeah, in theory, it sounds good, although we see a lot of people trading options that unfortunately really shouldn't. There's not a ton of stats on it, but the stats I've seen is a lot of people are not profitable trading options. It's one of those things that looks really easy from the outside, but once you're into it, it's a lot tougher. And then obviously there are some people who are successful at doing it. So I don't want to say it can't be done, but it's certainly much harder than it looks. But yeah, it probably would help on some of these products that at least have people say, I have this level of experience, this level of knowledge. It could potentially help, but I don't think it will totally solve the problem. Sadly, I think some people are unfortunately going to have to learn from experience no matter what we do. And as much as I hate to see that happen, I think that's just going to be part of the reality.
Yeah, exactly. So what is one trend you see playing out over the next year or several years? It can be investment related. It can be just popular culture. What's one trend that you see playing out?
Yeah, I think one thing we're watching is really the valuations of large cap stocks to small cap stocks. Our president, John Bukowski, wrote about it probably about, I think it was last month. Pure coincidence, a few weeks after he wrote it, a few other firms, like Shaughnessy Asset Management and a few others, started talking about the same thing. And it's really the difference in valuations between large cap stocks and small cap stocks. So if you look at the S&P 500, which is large cap stocks, and then the S&P small cap 600, the difference in the price to book ratio between the median stock and each of them historically has been about 1.4. When we got to early April, that range was about 2.14. I looked at it as of Friday, it was still about 1.98. So right now the spread is far above. And so what that tells you is that large cap stocks are really overvalued relative to small cap stocks, or alternatively, small cap stocks are really undervalued relative to large cap stocks. And so if you assume these things are in a pendulum, and pendulums do tend to swing back towards the center, and often investing to go past the center, it makes at some point these valuations are going to correct. And so what it means is at some point, we would expect small cap stocks to outperform large cap stocks by a pretty sizable margin. Now, the timing of it's really difficult to predict. There's a famous saying in investing that the reversion to the mean is a pain. And there's another version of it, which I'll keep this suitable for children's ears, but it's basically the idea that things eventually return back to their average. And whatever the average relationship is, they tend to revert back to it. And when that happens, it can be very painful. Say housing prices that fall in 2008. But if you're waiting for it to happen, that can also be a very painful period because you can see this trend coming. And while you're waiting for it to happen, things can continuously keep going in the other direction. So it's hard to say when this valuation difference will correct, but I do think at some point we will see small cap stocks go back to outperforming large cap stocks. Can I tell you when? No. Will it be next year? Possibly, maybe 5 years from now. That's possible as well too. But I don't think this valuation differential is sustainable, or even the fact that growth stocks have outperformed value stocks by so much for so long. I even think that's another trend that's eventually going to correct.
Great. So now for our speed round, this is trend or fad. I get to surprise you with a few different concepts. And you can tell me whether you think it's a trend or fad. You can explain it if you want to, or we can keep going.
Okay.
Day trading, trend or fad?
I think it's a trend. I think it's people like that speculation, like the energy, and I do not think it's going away.
Fractional shares, trend or fad?
I want to say that's actually going to be a trend, particularly as we continue to see companies that do not split their stocks.
ESG, trend or fad?
That's a tougher one. I'm going to go with a trend, although ultimately we could see a lot more companies becoming ESG out of necessity. But I don't think that's going away. This idea of investing with your values has been around for a while. I don't see it going away.
Pulling guidance, trend or fad?
That is going to be a fad until there's a substantial change in corporations not being focused on the short term. And right now, I do not see that short-term pressure going away.
And finally, walking, trend or fad?
Well, I'm a big believer in exercise, so I hope it's a continuing trend. I think it will end up being a fad, though. I think you will see people reverting back to using Uber and public transit once they feel safer about doing so.
Yeah, our producer, Phil Perlman, mentioned you were into exercise. What do you do? How have you been spending your COVID time? Are you a runner or what else?
I do some running and walking, more walking than running just because of my knees. I've done yoga. I guess I'm now getting probably about 17, 18 years now. So I do a lot of yoga, some weight training. So a combination of them. But one thing I think that's helped keep my sanity is every morning I get up and the first thing I do is put on my running shoes and head out the door. And going out when there's nobody outside and getting the exercise in certainly helps with sheltering in place.
Well, this has been great, Charles. Thank you very much for being on the episode today. How can people find you and follow you?
Absolutely. So our website's AAII.com. I'm on Twitter. My handle is Charles R. AAII.com. And so I'm also on StockTwits under the same handle as well.
And thank you for joining us for another episode of Trends with Benefits. Until next time, thank you.